Enterprise Products Partners ticker EPD is currently trading at $25.90 and is up by almost 7% over the last 5 years. Now, at the start of 2020, the stock experienced a large drop in its price, falling all the way down to $13.95. But since then, it has recovered back by almost $12 to the current price at $25.90. Now, to understand whether this stock is a buy at the current price, we'll jump over to my stock valuation spreadsheet where we will plug in the ticker for Enterprise Products Partners EPD and wait for all the important metrics to show up. To further analyze this stock, we'll have a look at the 9-pillar analysis, Graham's formula revised, discounted cash flow model, multiples valuation model, and the dividend discount model. And all these models will lead to our ultimate valuation at the end of the video. Now, to jump back to the stock screen, we can see that the current dividend yield of the company is sitting at 7.57%, which is a great starting dividend yield. The dividend payout is just about $2. Now, the payout ratio is sitting at about 75%, which is not a great payout ratio. I genuinely like the payout ratio to be below 50%, but 74% isn't that bad. We can see that the analysts project a price of $32.30 by the end of 2023, which is about $6 higher than the current trading price. Down here we can see that the beta of EPD is sitting at about 1.1, which shows that its volatility is fairly similar to the overall market. Up here we can see that the overall income of EPD has been increasing fairly well through the year 2022. On the other hand, the cash flow of the company has decreased quite a bit throughout the year. Now let's move to the 9-pillar analysis. Here we will plug in the ticker for the company we want to evaluate, EPD in this case, and wait for the metrics to show up. But before we dive into these very important metrics, I want you to know that the 9-pillar analysis is, in my opinion, the most important analysis of all these analysis models listed down here, as it really gives you a perspective of how the company has been operating over the last few years, and it can really allow you to understand if the company will be profitable over the next few years and if it's worth investing into. Now, right from the start, just by scanning the screen, we can see that the rating is 8 out of 9, so that's a very good rating. We can see that the 5-year P ratio is certainly below 22.5, sitting at about 11.3. The price to free cash flow is sitting at about 15. The consecutive dividend growth is sitting at about 3% over the last 8 or so years, which is decent. We can further see that the long-term liabilities over the 5-year free cash flow should be below 3. In this case, it's at about 1.5, which means that the company can pay off its long-term liabilities with its 7.5-year historical free cash flow. Now, there has also been an increase in net income and revenue growth over the last few years, increasing by about 16 and 18% annually. Increase in free cash flow by almost 40% over the last 5 years, which is great. The only metric that is in red here is the decrease in shares outstanding, and as we can see, they have increased by about 0.5% through the year 2022, which is not that big of a deal. Now let's move to finding the intrinsic value of Enterprise Products Partners, first using the Graham's formula revised. I've already plugged in the ticker symbol here, and right off the start we can see that the earnings per share of the company is sitting at about 2.47, which is fairly low for the amount of shares outstanding Enterprise Products Partners has. Now the 5-year growth estimate is also fairly bad for this company, sitting at 0.05, which is taking the intrinsic value down quite a bit. Now, to calculate the intrinsic value with the earnings per share, base PE, 5-year growth estimate, growth rate multiplier, average yield on AA corporation bonds, and the current yield on AA corporation bonds, which we all plugged into the Graham's formula revised and got the intrinsic value of $16.38, which is currently 58% lower than the current trading price. But let's move to the next valuation model, which is the discounted cash flow valuation model. We plug in the ticker EPD right here. And right off the start, we can see that the free cash flow over the last 10 years has been increasing by about 80% annually. We can further see that the analysts project a growth rate of about 25% over the next year. Now, even though these two metrics are sitting fairly high, I do not believe that EPD can sustain their current free cash flow, which is sitting at about $6 billion annually. And therefore, I think that a growth rate of 4.5% over the next 10 years is a very fair growth rate. I also plugged in a slightly lower initial growth rate number than the current free cash flow of EPD. Now, using these two metrics, I calculated the future free cash flow over the next 10 years. Now, to calculate the present value of that future free cash flow, which will lead to us finding the intrinsic value, you first need to calculate the discount rate. And we will calculate that using the WACC of EPD and the information we earned through the NIMPL analysis. Now, based on these two metrics, I project a discount rate of 8%, which I think is a very realistic discount rate for EPD. And this will give us an intrinsic value of $38.36, quite higher than the intrinsic value we got from the Graham's formula. But let's move to the next valuation model, which is the multiples valuation model. Here I have already plugged in the ticker symbol for EPD. I have also already plugged in the ticker symbols for the companies we'll be comparing EPD to. Now I took these companies' current stock prices and divided by their current earnings per share to get their PE ratios. I then averaged out these PE ratios and multiplied the average PE by the earnings per share of EPD to get an intrinsic value of $30.29. Again, fairly higher than the value we got through the Graham's formula revised. Now let's move to our final valuation model, which is the dividend discount model. Here we plug in the yearly dividend payout over the last 5 years and calculate the average growth rate. Now if we have a look here, we can see that the average growth rate in 2019, 2020 and 2021 has been quite lower than the growth rate in 2022. Therefore, I project a growth rate of 1.9% instead of a growth rate of 2.3%. After that, I plugged in the projected growth rate, the next year's dividend and the WACC into the formula we can see right here, and I got an intrinsic value of $35.45. Now we can jump to our ultimate value finder, and I have already plugged in the ticker here, and we can see that we average out the Graham's formula, the multiples valuation, discount cash flow valuation, and the DDM valuation to get an intrinsic value of $33.89, about 31% higher than the current trading price. Now as a value investor, I always plug in a margin of safety of about 10%, which should give us an acceptable buy price of $30.50. Now we can also plug in the higher safety margin of about 20%, and that will still allow us to buy the company at about $27.11. Now if you want to add this company to your portfolio, you should think about adding it now or in the near future, as it's currently trading quite below its intrinsic value. If you enjoyed the video, make sure to leave a like, make sure to subscribe, and make sure to let me know down in the comments which stock you would like me to evaluate next.